unfortunately, we have to talk about the indices today and the structure that still looks weak. After a strong jobs report and favorable CPI data that we got last week, we should have seen a more decisive upside reaction. The fact that we didn't is quite telling, and we've seen a lot of internal rotation and structure shifting more defensive under the hood. But markets typically don't ignore genuinely strong data, and when they do, it usually means that something really is changing under the surface that's starting to line up. So I'm not convinced the market fully trusts the jobs and CPI number. Job gains, as I mentioned last week, were unusually uniform across all the categories, and several CPI components declined even as the commodity input costs were rising during the same measured period. So that kind of divergence tends to raise some questions. Internally, leadership wasn't inspiring either. Defensive sectors, particularly utilities last week, were the primary areas showing strength on Friday. Utilities, they are stretched in the short term, but often when we have strong moves like this on a sector, we do see follow through the following week. Regardless, defensives leading after, let's say, good macro data is not exactly a vote of confidence and growth, and we are starting to see the first small signs of caution from the bonds market as well. If you are on Patreon, check out the post I wrote on that widening in the bond spreads, particularly on the tech side.